Hello and welcome to this video on advanced DuPont analysis. To conduct advanced DuPont analysis, we're going to be using our reformatted financial statements. So make sure you've already got a set of reformatted financial statements before you try and do your ratio analysis. The reason we need our reformatted financial statements is that advanced DuPont analysis separates the operating activities and the financing activities, and the effect on the ratios is therefore separated as well. It allows us to get a better understanding of the business's operating and financing activities and how that all combines into driving the firm's return on equity. So what is advanced DuPont analysis? Well, advanced DuPont analysis is a way of breaking down a firm's return on equity into various components. So here we've got a formula: ROE, return on equity, is equal to RNOA, return on net operating assets, plus FLEV, financial leverage, times spread. Okay, so let's break this down into some actual terms that we can utilize. A firm's return on equity, we know that we can calculate it as our comprehensive income divided by our average owner's equity. That would be a simple ROE calculation. What we're doing with advanced DuPont analysis is we're understanding the drivers of return on equity. So we're still going to have the same return on equity after we calculate it using this more advanced format, but we'll get a better understanding of what's actually driving the business's performance utilizing this. So return on equity is equal to NOPAT over sales. NOPAT is the net operating profit after tax, and you get that from the reformatted income statement. So we said we need to have reformatted financial statements before we can do advanced DuPont analysis. Terms like NOPAT are from the reformatted income statement. So this would be called our operating profit margin ratio. It's our operating profit divided by our sales. It's very similar to a normal profit margin ratio, right? The normal profit margin ratio would be net profit divided by sales. Here we're doing operating profit divided by sales. So that's going to be our operating profit margin. We then multiply by sales divided by average net operating assets. NOA, net operating assets, is on our reformatted balance sheet. So this would be called our operating asset turnover ratio. Sales divided by average NOA is operating asset. So what we've just done there, we've multiplied the profit margin times the asset turnover, and that would give us what's called return on net operating assets. The profit margin times the asset turnover is return on net operating assets. This section of the formula is going to tell us about our operating performance. Our operations are driven by our profit margin, how much we choose to sell our product for, how much we spend on our expenses like our staff levels and all those other things like how much we pay for our inventory. They're all operating decisions. They drive our profit margin. How quickly we're able to sell our products, how efficient we're able to utilize our assets to generate sales, that drives our asset turnover. Those combined gives us our overall return on our operating assets. Then the next part of the formula, we're starting to look at the financing activities of the business. Average NFO divided by average OE, net financial obligations from the reformatted balance sheet, and our owner's equity. This is a measure of the firm's financial leverage. Essentially, it's similar to what you would have done previously with a debt to equity ratio, except this time it's only looking at financing debt. Okay, so from our reformatted balance sheet. So financial leverage tells us how much of the firm is financed using debt rather than equity. And then we can multiply that through by a term that's called spread. RNOA was our return on net operating assets. And we calculated this over here when we multiplied the profit margin and asset turnover. That is the return on net operating assets. So you would have already calculated it in the first part of the formula. Minus NBC. NBC stands for the net borrowing cost. The net borrowing cost is net financial expense after tax divided by your average net financial obligations. Your net financial expense after tax is essentially how much interest you have paid during the year, and the average NFO is essentially the amount of debt you have. So NBC, to simplify it and try and remember what's actually happening, is pretty much the interest rate you are paying on your borrowings. Okay, so if my NFEAT for the year was 100 and my average NFO was 1,000, I could think about that as my interest rate is about 10%. I've borrowed $1,000 and I had to pay $100 interest. My interest rate is therefore 10%. Okay, so NBC is getting at the concept of what interest are we paying on our borrowings, and the return on net operating asset is how effectively we are using our assets to generate returns. So we want this spread term to be a positive number. If I can invest my money into assets that are generating a 15% return, and the interest I have to pay on my debt is 10%, I have a positive spread of 5%. So the more money I borrow, if I'm able to borrow money at 10% and I generate 15% returns from it, I'm generating a positive spread. That's going to be good for the business. It's going to mean that as I'm borrowing money, I'm levering up my returns. As my financial leverage increases, if spread is positive, that will overall have a positive effect on the return on equity. Okay, so there was a lot to take in there as we looked at the different components of the advanced DuPont analysis. Essentially, it's still calculating the same return on equity number that we've seen all the way down from introductory accounting. It's just breaking it up into operating components, and the operating side of things are the profit margin and the asset turnover ratios. And then it also separates out the financing effect. How much you have borrowed, your financial leverage, and how effectively you use that borrowing, the spread. Are you able to invest the money that you're borrowing at a higher return than the interest rate? Okay. Once you've done that basic ROE decomposition, you can actually break down the various ratios into this family tree kind of structure. So right up the top, we've got our return on equity. And now we know return on equity can be broken down into subcomponents. We saw that return on equity could be the return on net operating assets. That was also broken down into profit margin times asset turnover. But then within the profit margin category, you can break down various profit margins. Instead of doing just NOPAT over sales, we can break this down into the different revenues and different expense items and calculate various ratios at the account level. Okay, so this family tree here just shows that all these ratios under this approach actually build into the ROE. So it allows us to get a much better understanding of what's actually driving the firm's performance, all the way down to individual accounts that influence the profit margin, individual accounts that influence the turnovers, and individual accounts that drive the borrowing costs as well. So with this in mind, when we've broken down ROE, we calculated return on equity, and that would be our realized return for the period. And to create value, a business must generate return on equity that's higher than their cost of equity capital. We also said one part of our ROE was the return on net operating assets. To generate value, our return on net operating assets would have to be higher than the cost of capital for the firm. And on the debt side of things, we said generally financing activities don't create value for a firm, which is why we want to separate them out. So the realized return for the debt holders would be the net borrowing cost. That's kind of the interest rate we're paying. And the required return would be the cost of debt capital. And these two are normally the same. Banks are very sophisticated. They're going to lend to a borrower at their cost of debt capital. So it's very hard to generate returns on the debt side of things. We generate returns based on our operations being able to generate returns higher than our... Okay, let's look at the individual components in a little bit more detail. Let's look at the profit margin. So we want to be able to assess the profitability of operating management, and profit margin is going to be one of the ratios. We said the profit margin was NOPAT divided by sales, and it tells us about the profitability of each dollar of sales. So if I make $1 million of sales and my NOPAT is $100,000, that means my operating profit margin is 10%. For every $1 million I sell, I get to keep 10% of that as a profit. We can break down the profit margin into various subcomponents, as we saw in that family tree figure, and that can give us a better understanding of what's actually driving our profit margin. So we can identify the material expenses and controllable expenses within the organization and see how they're influencing the profit margin. So let's have a look at an example using Qantas. This is some old data from Qantas, and it's looking at all their different expenses as a percentage of total revenue. So when we disaggregate the profit margin figures, we're dividing through, first of all, NOPAT by sales, but then as we break it down, we can break it down into the various different levels, such as the different expenses by sales, which is what we've done here in this Qantas example. So just from a quick glance at this data, we can start to understand the key drivers of Qantas's profit margin. Their largest expenses in 2012, manpower expense is 24% of their revenue. That's their salaries for their employees. Aircraft is 19%. That's actually paying the costs of running those aircraft. And fuel and oil expense is 26%. Now, as we look, this was in 2012, as we look back in 2005, the fuel and oil expense was only 15% and the salaries were by far the most significant amount. This indicates that without knowing much about the airline industry, without knowing much about the oil markets, the fuel and oil expense has started to take a significantly higher portion of Qantas's revenue. If we look at that time, we can see the oil price rose. We know that oil prices are not something that Qantas can really control in any way because it's a commodity. And so that's going to be leading to a big reduction in their overall profit margin as the fuel price goes up and up and up. Unless they're able to increase their ticket prices just as much, it's going to reduce their profit margin. So when you're analyzing Qantas, you can see there's these three really large big accounts. Fuel and oil expense for the large part is not something they control. The aircraft expenses, well, because there's only two airline suppliers, which we talked about in Porter's 5 Forces, Qantas don't have much bargaining power on how much it costs to actually buy an aircraft. And so therefore, their manpower expenses is something they're really careful with. They've had lots of negotiations with their unions in the past. Workers have gone on strikes. The airline even was grounded for a few days while workers were on strike. The reason for that is Qantas, this is one of their largest expenses, and it's one of the only expenses they have any sort of control over. So they're really strict in trying to manage that expense and keep it as low as possible from their perspective. Now we're going to look at the asset turnover ratio. The asset turnover ratio assesses how efficiently you're using your assets. So if you can think about a really simple business example, like you go and set up a coffee cart out the front of the UTS library. So your only asset is you've got a coffee machine and some sort of table. How efficiently or effectively are you utilizing that coffee machine to generate sales? Well, if you're getting lots and lots of sales and you're really busy all day, that machine's in operation all day, and that machine, which might have cost you $5,000, is generating lots of sales because you're using it all the time, generating a lot of sales from it. However, if you're only getting a couple of customers a day, that machine, that asset that you've got that's worth $5,000 is not generating as many sales, so you'd have a lower asset turnover ratio. So the asset turnover can be broken into two primary components: your working capital management, that's sort of your short-term assets, and long-term asset management as well. So similar to what we just did with the profit margin, the asset turnover ratio can be broken down into various subcomponents. And one that's really common to look at would be your inventory turnover. How well are you selling your inventory? So working capital is the difference between current assets and current liabilities. So it's kind of your short-term assets that we're looking at, or short-term net assets. And the key ratios to look at here would be your accounts receivable turnover, your inventory turnover, and accounts payable turnover. These are really important accounts for many businesses, especially something like inventory, where we want to make sure we're selling our products. We're not getting lots of inventory stuck in our warehouses that's becoming obsolete or unfashionable. And for accounts receivable, we want to make sure that our customers are paying their bills quickly. We're not having problems with bad debt expenses or anything along the lines of that. So when we break down the asset turnover ratios, the most common way of doing it is we say asset turnover equals sales over NOA, but then we can take the inverse of that. So we can flip it around so that sales becomes the denominator. So we can go 1 over the asset turnover ratio, and we can break down the various accounts such as inventory over sales, accounts receivable over sales. It allows it to be a little bit more sensible when we read it, a little bit more logical in interpreting what the numbers mean. So let's have a look for Qantas. We've got the sales number as the denominator, and then we've broken down some of the various assets that they have just to see how those turnovers are changing. And you can have a look at something like property, plant and equipment over sales. The property, plant and equipment over sales has been decreasing through time. As the property, plant and equipment divided by sales is decreasing through time, that actually indicates good news for Qantas in that they need less assets to generate their sales. It means they're becoming more efficient in their operations there. So that would be interpreted as good news. We'd then want to investigate, have they purchased better planes that are more efficient and require less costs, and all those kind of things would be useful to try and figure out what is driving it. How come their property, plant equipment is now more efficient than it used to be? Finally, we need to look at the financing effects of the business. The profit margin and the asset turnover told us about the operating side of the business. Now we need to move on to understanding the financing act. So financial leverage affects a firm's return on equity. If your cost of debt is lower than your return on investing, as you borrow more, your return on equity will increase. It will lever up. However, it's also increasing your risk because if your returns are less than your cost of debt, your return on equity is going to go down very quickly as well. So from the equity holder's point of view, ROE can be increased via successfully using debt. However, it can also increase the risk of the firm. So as you borrow more money, there's upside, but it also increases the risk. There's downside as you have to make those debt repayments and pay the interest bill on time. So the financing effects are our financial leverage multiplied by spread. Spread is the difference between our return on net operating assets minus our net borrowing cost, which is essentially the interest rate we pay on our debt. So there's a positive correlation between financial leverage and your net borrowing cost. As you borrow more money, banks will charge you a higher interest rate, and that reflects the fact that there's increasing risk. So if I've currently got a 50% financial leverage, and I significantly increase that by going to the bank and borrowing millions and millions of more dollars, they'll probably start charging me a slightly higher interest rate to take into account that extra risk. So when we're looking at financial leverage, we need to understand the effect of our financing decisions on ROE. Are we able to successfully use debt to improve our return on equity? And that's going to be a function of what our borrowing costs are. Okay, what interest rate do we have to pay? How well we're investing our money. Are we able to generate a return higher than our borrowing cost? And then finally, we need to look at the financial risk. Do you think borrowing more is going to significantly increase the firm's bankruptcy risk? Will the firm be able to make the debt repayments as they fall due? So understanding how much debt to use is one of the impossible questions to answer in finance. There's lots of different theories about how much debt firms should use, but it's really hard to nail down an exact answer. So you need to be able to weigh up the benefits and the costs and try and evaluate if they make sense for your particular company. So the benefits of debt financing, it's cheaper than equity because of predefined payments. So if I'm an investor, I can invest as a debt investor. I could go and go and buy bonds, or I could go and buy equity. So I could invest in either debt or equity. When I invest in debt, I get a guaranteed payment. It's lower risk for me as the investor. So I demand if I'm an equity investor, it's very uncertain. I might get paid a dividend, I might not. There might be capital gains, there might not. So it's a much riskier thing. So overall, I expect equity investments to have a higher return than debt because they're riskier. Interest can be tax deductible. So as a business borrows money, it has to pay an interest expense, which lowers profit, which lowers the tax payable. Compare that to equity finance. Equity finance, if you go and sell shares to your investors and get more cash, that's not a tax deduction. So there's two ways to finance your business, debt or equity. Debt repayments are tax deductible. Equity repayments are not tax deductible. So there's a benefit to debt there. It can provide extra discipline on management. Think of it this way. If you go and buy a house and get a big mortgage, you're going to have to be pretty disciplined with your finances because you don't want to miss your mortgage repayments. It's the same for a business owner. If they've got a lot of debt and they have to make these bank repayments regularly, they're going to be very disciplined in how they run their business to make sure they make their interest repayments on time and they're operating the business in a way that's sustainable. The fourth point is it's easier to communicate private information to debt holders than equity holders. So in Australia, the rules are that for a publicly listed company, if they want to release information to one shareholder, they have to release it to all shareholders. So they have to continuously disclose important information about their business to the public. Now that's important because it means the share market is hopefully an equal playing field. I'll have just as much information about a company as someone who's working for an investment bank. On the other hand, debt holders don't have to have those same rules. So when you go and negotiate with your bank, you can give them all the private information about your business. It doesn't have to be publicly disclosed. In fact, it's going to be kept highly confidential. So you don't have to worry about your competitors seeing all your important financial documents and forecasts for the future and strategic plans. So you can maybe borrow more money from a bank because they're going to have a good understanding of your business compared to going to a public debt market if you don't want to uncover your secret information that you don't want competitors to know. So overall, there's some benefits of debt financing. How much debt we use, that's going to change business to business. There's no one-size-fits-all amount of debt. It's going to vary based on your business's operating risk. So if you're in a very safe industry, maybe a utility company or something like that, or you've got government contracts, you might be able to use more debt safely than if you're in a highly volatile industry like the airline industry, which has clear fluctuations and cycles that can be swing up and down very quickly. So how much debt should you take? Look at your firm's operating risk. Think about if they're likely to be able to pay the debt, the interest, and even when things go bad, will they still be able to make those payments in an industry downturn? So in conclusion, we've looked at the breakdown of return on equity, and we've called it advanced DuPont analysis, and that indicates we're using our reformatted financial statements. So our return on equity, we know, is now broken down into operating activities and financing activities. The operating activities tell us about the firm's profit margin, which is the first term, NOPAT divided by sales, times their asset turnover, which is the second term here. Then the next part of the formula tells us about the firm's financing activities. How much money have we borrowed, our financial leverage, multiplied by how well we're utilizing our borrowed funds, the spread of the business. Doing advanced DuPont analysis is going to provide a much cleaner and better understanding of the true drivers of a firm's performance relative to using unreformatted statements where the financing and operating activities are mixed together and influence these ratios in a mixed way. So overall, advanced DuPont analysis is the way to go for financial statement analysis, and there are other ratios as well that we need to look at, which will tell us different things about the business, including solvency and risk ratios. Thank you.